Have you ever found yourself lost in the labyrinth of investing data, unsure which metrics truly matter? Imagine if I told you that mastering just 10 investing metrics could be the key to unlocking your inner Warren Buffett. In a world filled with information, it's easy to overlook the simplicity that underlies success. So are you ready to cut through the noise and discover the magic behind these 10 must-know metrics? Join me in this video where we demystify investing and empower you with the tools to excel in the world of finance. What's up, strangers? Welcome to the Wealth Game Nation. My name is Vedo and I'm here to help you better understand the Wealth Game and become part of the Wealth Game Nation. So let's get right into the top 10 metrics you will ever need in order to become a great investor. First of all, do not get discouraged by this table and the amount of data that is in this table. I try to make this as simple as short as possible, but still, it is a lot of information, so make sure you pause and rewind where needed. Once we go over one metric, we will also look at that metric in two examples based on the companies I am currently invested in. Let's get started. First up, revenue growth. Revenue is reported in the quarterly filings, and it can be found in the income statement. As this information shows up in the first line of the income statement, it's also sometimes called the top line. I like to look at this metric on a year-over-year change and also the average growth rate over the last 5 or 10 years. For example, Alphabet, a company that I'm invested in, has increased its revenue by 4% for the trailing 12 months. Alphabet has also increased its revenue over the last 5 years by 18.4%. Another example is Microsoft. I'm also invested in this company, and Microsoft has increased its revenue by 6.7% for the trailing 12 months. Microsoft has also increased its revenue by 13.8% on an annual basis for the last 5 years. As you can see in the yellow coloring, I believe this is a moderate growth rate. Next one is net income growth, and it comes somewhere towards the bottom of the income statement. That is why this metric is also sometimes called the bottom line. However, in my opinion, this is not the bottom line. I believe that net income is not the best metric to value companies. The reason for this is there are some expenses in the income statement that are not cash expenses. For example, if a company A holds investment in a company B and the value of company B goes down or even up, the company A needs to report this difference as unrealized profit or unrealized loss in the income statement. And therefore, when the investment in company B goes up in value, then this artificially makes the net income look better. Same thing vice versa, when the investment in company B goes down, then the net income of company A looks artificially lower than other non-cash expenses such as depreciation, amortization. Basically the hardware or the equipment or the real estate that the company A owns depreciates and loses value over time. Then there are things like stock-based compensation, which is a very important topic, but topic for another time. Even though it's not a cash expense, it's a very real expense for the company. Then there are things like restructuring charges or impairment charges and other types of one-offs. For this metric, I also like to look at the year-over-year change as well as average growth rate over the last 5 or 10 years. If you look at an example, Alphabet decreased its net income by 15% for the trailing 12 months. And this is one of those things. However, Alphabet has been increasing its net income over the last 5 years by 28% on a yearly basis. And as you can see by the red background for this metric, this is not good. On the other hand, I gave Microsoft the yellow background. It is okay for the time that we find ourselves in. Microsoft net income has decreased by 0.5% for the trailing 12 months, so basically flat. However, Microsoft net income for the last 5 years has been increasing by almost 33% on a compounded annual growth rate basis. Next metric is price to earnings ratio, or PE. This metric is calculated by taking the price per share, dividing it by earnings per share. We talked about net income as the bottom line of the income statement. Beneath the net income, there's also something called shares outstanding. It tells us how many shares of the companies are in circulation. And below that, there is something called earnings per share, basically taking the net income, dividing it by the number of shares outstanding, and you get to the earnings per share. So in order to calculate the PE ratio, you need to take the price per share and divide it by the earnings per share. Alternatively, you can calculate the earnings per share also by taking the market cap and dividing it by the earnings of the trailing 12 months. Then you can play around with this metric and find out what is the earnings margin. So basically taking the net income and dividing it by the revenue and multiplying by 100. Then there's earnings yield. The earnings yield you can calculate either on a per share basis, taking the earnings per share, dividing it by the price per share and multiplying with 100, or you take the total net income and divide it by the market cap. You come to the same earnings here. However, you can see here I highlighted in green my favorite way of calculating the earnings yield, which is you take simply 100 and divide it by the PE. This is the best way and the easiest way to calculate the earnings yield. That is because multiplying the PE with the earnings yield will always have to result in 100. For example, if a company has a PE of 25, you take 100 divided by 25 and you get 4% yield. Also other way around, you take 25, multiply it by 4 and you get 100. That's the formula I use to calculate fast what is the earnings yield. If you look at the example of Alphabet, current PE is around 27. The average PE over the last 5 years is around 28. That tells me that the stock market has historically priced Alphabet higher than it's currently pricing it. So potentially it could be that Alphabet is currently a little bit undervalued, which is what I'm saying. You need to do your own research on this. However, the current earnings yield is 3.74, and this 3.74 you would get by taking 100 and dividing it by 26.7. As you can see by the highlight, I give this a green background because I think today a lot of things are overvalued, and historically, based on the PE ratio, Alphabet does not seem overvalued. On the other side, we have Microsoft. Microsoft's current PE is around 33. The average PE of Microsoft for the last 5 years has been 32. That tells me that currently investors are paying a little bit more than they were historically willing to pay over the last 5 years when it comes to Microsoft and PE ratio. The current earnings yield is 3%. Next metric is free cash flow growth. This is for me the most important metric, and every metric that has to do with the free cash flow for me is an important metric. The free cash flow is calculated by taking the operating income and subtracting the capital expenditures from it. The operating income can be found on the statement of cash flows. It is the last line in the first section of the statement of cash flows. The information about the capital expenditures can also be found in the second section called investing activities. Then you can also figure out what is the free cash flow per share. Basically, you take the trailing 12 months free cash flow and divide it by the shares outstanding. It's also important to pay attention what is the free cash flow per share, because if the company's free cash flow is increasing, but the company is also creating more shares by dilution or stock-based compensations or whatever else, it does not mean that the company is then doing so good. You can also calculate the free cash flow by excluding the stock-based compensation to get even a better understanding of the free cash flows. If you look at an example of Alphabet, Alphabet has been increasing its free cash flow by 9% for the trailing 12 months. However, over the last 5 years, Alphabet has been increasing its free cash flow by 27% on a compound annual growth rate basis. But then if you look at the free cash flow per share, the increase is around 28%. And as you can see, there's a difference between free cash flow and the free cash flow per share by around 1%. This is where the shares outstanding come in. We will come to it a little bit later. We will find out that Alphabet has been decreasing its shares by around 1% for the last 5 years. And that's where the free cash flow per share increase is better. For those numbers, I give this a green background for the free cash flows for Alphabet. On the Microsoft side, the free cash flow has been decreasing by around 9% for the trailing 12 months. However, it's been increasing by almost 14% for the last 5 years on an annual basis. If you look at the free cash flow per share, it's also been increasing by almost 15%. And we see here again 1% difference. And this is where the number of shares outstanding come, because later we will see, but you can see it also now on the table, that Microsoft has been buying back shares by around 1% annually. Next metric is the price to free cash flow, and the price to free cash flow can be calculated by taking the market cap and dividing it by the trailing 12 months of the free cash flows. You can also calculate the price to free cash flow on a per share basis, taking the price per share, dividing it by free cash flow per share. Similar to the income, you can play around with the margin and with the yield. Here you can see I put the text in green and bold. Free cash flow yield is easily calculated by taking the number 100 and dividing it by the price to free cash flow. We can see for Alphabet, the current price to free cash flow is around 23. Historically, the average price to free cash flow of Alphabet has been 29, and the current yield is 4.3. Here I give the green background because historically Alphabet has been priced higher than it is currently. On example of Microsoft, the current price to free cash flow for Microsoft is 40, and historically it's been around 33. That's why I gave it here a red background, because currently on a price to free cash flow basis, Microsoft is more expensive than it was the last 5 years on average. And the current free cash flow yield is 2.5, and then simply we get this 100 divided by 40, you get 2.5. Next metric is a debt to equity ratio. Debt to equity ratio is calculated by taking the total liabilities and dividing it by the book value, or sometimes called the shareholder equity. Both of these numbers can be found out from the third financial statement called balance sheet. The balance sheet is split into 3 sections. There are assets, liabilities, and shareholder equity. And the assets and liabilities are split into current assets and liabilities and total assets and liabilities. The difference is everything that is current means for the next 12 months. Everything that's total obviously means everything in total. And the book value is calculated by taking the total assets and subtracting the total liabilities. When you do the debt to equity calculation, the lower the number, the better it is. You can also try to find out what is the tangible book value, basically taking the total assets and subtracting the intangible assets and the total assets. And the intangible assets are also reported on the balance sheet. And the intangible assets is an asset that Warren Buffett calls phony assets. This is because you can't find out what is the value of such an asset. And intangible assets include things like patents or intellectual property, or for example in Disney's or Netflix entertainment industry, those are for example the characters behind it. Sometimes the debt to equity ratio can be a good ratio, but then you look at it a little bit closer and then you see the intangible assets are making up 30% of the total assets. Then you do the calculation of the intangible book value, then you get a better understanding of the debt to equity or the book value. For Alphabet, currently the debt to equity ratio is around 0.4, and on average for the last 5 years it's been also around 0.4 if you want to round it up. In Microsoft's case, debt to equity is currently at 1, and the average debt to equity over the last 5 years is 1.4. Here I give them both green backgrounds because these are all great debt to equity ratios. For Alphabet, it hasn't been moving much for the last 5 years. It's been staying at the same low level. In Microsoft's case, you can see even though it's a little bit higher, it's been going down over the last 5 years. Next metric is the price to book ratio. The price to book ratio is calculated by taking the market cap and dividing it again by the book value or the shareholder equity. Here it's the same thing. The lower the better. And here you can also calculate the tangible price to book, basically taking the market cap and dividing it by the tangible book value. Both Microsoft and Alphabet have low price to book. Alphabet's current price to book is around 6 and the average been around 5.5, so slightly increased. On Microsoft's side, a similar story as with the debt to equity. It is lower now than in the last 5 years, however it's higher when comparing it to Alphabet. Next metric is the shares outstanding. I think this is a very underestimated metric and it's a metric that the investors don't pay attention enough. For this metric, I like to look at it on a year-over-year change and also the average growth rate over the last 5 or 10 years. Of course, the lower the better, and that's why I'm highlighting this in green, because this tells you where are things moving when it comes to a per share basis. So when you calculate net income or you can calculate the free cash flow per share, this is where it gets interesting. If you look at an example, Alphabet has increased its shares outstanding by 3% over the trailing 12 months. However, over the last 5 years, it's been annually decreasing it by around 0.7%. And if you look at back to free cash flow, the free cash flow per share of Alphabet has been growing faster than the increase of the free cash flow itself. However, given the fact that they have diluted by 3% for the trailing 12 months, I gave it a yellow background. In the example of Microsoft, Microsoft has decreased its shares outstanding by 0.5% for the trailing 12 months, and they have been decreasing it by 0.8% annually for the last 5 years. Next metric is called price to earnings growth ratio. This ratio has been popularized by Peter Lynch, who happens to be my favorite investor. Here it's also the lower the ratio, the better it is. And the PEG ratio is calculated by taking the forward PE and dividing it by the forward earnings growth rate projection. The original formula doesn't include dividends, but I have added here dividends because dividends are also a return that you're getting. If we do a quick example and company A has a forward PE of 25 and the company A doesn't pay dividends in this case, and the company is expecting to grow by 25% this year, that would mean 25 divided by 25, it is 1. The ratio would be 1, and therefore, according to Peter Lynch, this would be fair valued. Alphabet's current PEG ratio is 0.47. That is because the projection for the earnings growth rate for Alphabet for the next year are much higher than the current PE. In the case of Microsoft, it's the other way around. The current PE of 33 is much lower than the expected earnings growth rate projection for the next year, and therefore the current PEG ratio for Microsoft is 1.8. Last but not least is the risk premium ratio. This ratio has been popularized by Benjamin Graham in his book The Intelligent Investor, and it's also sometimes called the margin of safety. Here it is the other way around. The higher the ratio, the better it is, and it's calculated by taking the free cash flow yield and dividing it by the 10-year bond yield, which is considered a risk-free return. This ratio also tells you where do we find ourselves in the current economic cycle. If you don't know about the economic cycle, I suggest checking out my video in which I explain the economic cycle in detail. This is very important to know because it tells you where on the wave or the curve we find ourselves in. In short, there are 4 phases of the economic cycle. There is recovery and expansion, basically when the economy is booming. Then there is slowdown and recession, basically when the economy is shrinking. Back to the ratio, this ratio tells us where do we find ourselves in. That is because it takes the bond yields into account, and the bond yields are higher when we are in a slowdown and recession, and the bond yields are lower when we are in recovery and expansion. The bond yields are currently at around 4%. The free cash flow yield for Alphabet is around also 4%. Therefore, 4% divided by 4% gives us 1. The average risk premium for the last 5 years for Alphabet has been 2. That is because in the past, the bond yields were lower, 1 or 2%, which makes the risk premium for Alphabet much higher. Basically, the investors are being compensated for the risk that are taking. On the other hand, Microsoft's current risk premium is below 1. If we look here, the current free cash flow yield for Microsoft is 2.5. So if we take 4 divided by 2.5, we get around 0.6, which is below 1. And that means that the risk-free premium, the 10-year bond yield in this case, would be a safer bet than Microsoft's free cash flow yield of 2.5%. And this is where it depends on the economic cycle. For the last 5 years, the average of Microsoft has been 1.8. Again, in the past, the bond yields over the last 5 years, the bond yields have been lower than they currently are. If you're still here, I have added one bonus ratio. It's a very simple ratio and it tells you how safe the current balance sheet is. It basically takes the current assets and divides it by current liabilities. We said everything that is current, that is for the 12 months, and the higher the ratio, the better it is. That would mean that the current assets are much higher than the current liabilities. And if we take a look on an example for Alphabet and Microsoft, both of them have green background because both of their current ratios are much higher than 1. Basically, they have much more assets than they have liabilities. Those were my top 10 metrics when I consider investing in a new company. Obviously, there are a lot more metrics, a lot more variation of those metrics, and also a lot more valuation methods. But this is the gist of it. If you understand those, then you're good to go and you can invest into individual companies. If you don't understand them, then it's better to stick to a broad market ETF until you do understand these metrics. But don't worry, I will be there to help you with that. And that's it for today. Thank you for joining me. If you found this video helpful, please hit that like button, subscribe to the channel and share this video with your friends and family. Also, in the comment section, let me know which valuation method or metric would you like me to cover in one of my next videos. Finally, if you're interested in a full review of my own stock brokerage account, check out my portfolio update video. The link is in the description of this video. Thank you so much for watching. I hope you enjoyed it and I will see you in my next video.